All right. So looking forward as we kind of move into Q4 and Q1, we're going to touch on a couple of things that we have in play and what our strategy continues to be as we move into, the end of this year and next year.
Yes. So, I mean, I think we alluded to it earlier about the two deals we have under contract. So maybe I'll share about Pleasant Grove Townhomes and you could take Saddlebrook.
That'd be great.
So Pleasant Grove, 117 units, all townhomes, pretty even unit mix between ones, twos, and threes. This is an off-market opportunity from a long-term owner. He's owned the deal for about 10 years. His portfolio is really focused on industrial and office assets. This is actually his only multifamily holding, that we're aware of, and especially only multifamily holding in the Wilmington market, which is where this is. Really little to no management presence as well. They had fired managers about 3 months ago, and they have a local group in there. I don't think larger multifamily is necessarily their forte. So yeah, really little online presence. We got the deal in on a Wednesday. We underwrote it pretty quickly. I booked a flight Sunday night, toured it Monday, and we were in contract within 10 days of actually getting the deal in. So we moved at a very fast speed. We went down, just great product, cathedral ceilings, 42-inch cabinets, direct access, private yards in 100% of the units, 100% of the twos and threes, I should say. It's in a great location, really strong demographics. So, really excited about this one. We'll be closing that in Q4 here in a couple of weeks.
Yeah, I mean, all townhomes, obviously a huge feature. And, we've been really hunting for the better part of a year since we bought Flats at Leland.
Yeah.
Given that was 126 units and we wanted to build a presence in and around Wilmington. This is a great sister property. Our manager at Flats, now that we're stabilized there, is super excited to kind of take this one on. It's really the main thing I would add. And just love the all brick. Again, 2002, 2008 construction. Falls in line with what we're trying to accomplish here of good quality product to add to the portfolio. Floor plans are great. So we also have Saddlebrook Apartments, very similar, somewhat similar story as Pleasant Grove, but this one we've really been working on for, not 2 weeks, more like 3 years. This is down in Murfreesboro, Tennessee, where we currently own Farmhouse Apartments. We had been introduced to the grandsons of the original developer back when we first came into the market. Grandpa had developed probably about 5 or 6 multifamily communities back in the late 90s, early 2000s that have never left the family. And these are assets that are just primed for kind of professional ownership and next generation of operations. So we befriended the grandsons and, kind of helped them through their refinance process. They made some strategic investments in the property. Our management team gave them a little bit of assistance on getting set up, and they've done a really good job, over the last 3 years of kind of doing some of the blocking and tackling, given that it's been, family owned and operated since inception. It was built back in 2001. It needed some work, and they did some of the heavy lifting. They did the roofs, they did the parking lot, they started to do the HVAC replacements, and then they started to implement an interior unit renovation plan. They've gotten through probably about 30% of the property, and I think they're at a point now where they had bought out one of the uncles a few years back, and it's just the 2 grandsons and their dad, and they're kind of looking to do different things. So that was our whole intent in working with them and helping and building a relationship with them, was that if and when the time came to sell it, they'd come to us. And we were literally the first and only group that we went to. We met with them several times over the summer, a lot of back and forth. They're not transactors. So, it was just a lot of getting comfortable. And we're super excited. We're closing in January. Again, 267 units, 2001 vintage. Just, some of the operational things to give you an idea. They don't charge any other income, period. All their leases expire at the end of the month for 12-month lease terms. It's just bringing the professional management to it alone is going to be a value add. But then we're going to continue the interior renovation program. It's about 10 minutes from Farmhouse Apartments. It'll give us 600 units. It'll give us real scale, real efficiencies in the market. And it's kind of more gray collar housing versus farmhouse, which is more, call it A to A plus, and this is more in its current state, probably B minus after we're done, B to B plus type of gray collar housing. So we think, we're super bullish on Murfreesboro, Rutherford County long term. Yeah, I think we've seen it. It's probably one of the fastest growing.
It's the fastest growing county in the state of Tennessee for the last 5 years, I believe. Which is, obviously extremely impressive. For us, it's like you hit the nail on the head. We're in Murfreesboro. We have Farmhouse Apartments. We have Cobalt Road. Both those deals are 5 miles away from Saddlebrook. These guys have spent the money on the large deferred maintenance items, the large CapEx items, new parking lots, new roofs. They've started the interior program. They haven't done, like you said, they've done about a third. And they've proven the rents too, right?
Yeah.
On their renovated interior offerings, they've received $150 premium.
Yeah.
So we can kind of take that, refine it, get it into our standard deluxe or platinum finish, and just continue to do what they've done while adding the management, efficiencies that we know, we can do and what we can bring to the table from the management side.
Yeah. I think that leads in well to Farmhouse Apartments. We actually just closed our refinance there. That was, again, new development. Chris and Tom and the whole team did a great job kind of working through that process. And maybe just walk us through some of the final terms there.
Yeah. So on the farmhouse refinance, final loan amount was $48,500,000. Fixed rate loan, 7-year product. Our final rate was sub 4.9. It was 4.87, I believe, with the final terms there. 5 years interest only, which is great. So we expect to, continue to improve operations and really get some cash flow out of the property and distributions back to our investors. And the main thing, we're north of 25% with a 27% return on capital to all of our investors.
So as we continue to, look forward, we want to maintain our acquisition pace. We do continue to believe that, the current environment represents probably one of the most compelling buying opportunities in the last, 10 to probably now 15 years since the last cycle reset post GFC. That's when we started buying. We're not seeing the grave distress of post GFC, but for all the reasons we've mentioned earlier, there's a lot of dislocation that still exists, right? So we're seeing different baskets of sellers that have different motivations for different reasons, right? For example, I think as of late, we've been seeing more and more of the developer forced sale, preferred equity forcing the sale on the developer, right? So groups that started building in 2021, 22, had big projections. There was very healthy rent growth going on. Interest rates were basically, you could borrow construction loans probably at, sub 4% at the time. Those loans probably moved to 6, 7, 8, 9%. Lease ups got, really challenging. Rent growth stopped, as these units are now. So you start a property in 21, you deliver it in 23, it's a completely different environment. There's no rent growth. You've got tens of thousands of apartments being delivered at the same time. Interest rates are up 500%. So those deals have been extremely challenged to get to stabilization. And I think a lot of those developers also utilized high leverage financing tactics, right? Whether it was, aggressive bridge loans or taking a bank loan at 60% loan to value or cost, but they added 20% preferred equity on top of that at 12, 13% interest rates for that slug of capital. And we're seeing more so as of late. That's kind of like the shadow distress, I guess. Distress, I guess, that rhymes. Like the shadow distress where preferred equity is saying, guys, nothing's getting any better anytime soon. You're not going to make your money. We want our 20% slug out of the deal. So we're stepping in and enforcing our rights, basically, as per their documents, to now turn around and force a sale, 3 years later. And that money's been accruing at 12, 13, 14% compounding because it's typically IRR driven. So now the developer's equity, their last 10% of equity is getting completely wiped out. They're losing control. And the preferred equity now is in the driver's seat saying, we want to sell. And they don't care about maximizing every last dollar. They just want their senior loan paid off from the lender, and they want their preferred equity out, plus whatever return they can, scrape off the top. So we're seeing those deals are trading at really attractive basis relative to, the cost of construction at the time, and even more so replacement costs today. And it's a great profile because the emotion's out of it, where it's not the developer necessarily that's in charge anymore that's saying, no, I want to wait. I'm going to wait. I'm not going to sell. I'm going to try to refi. I'm going to try to do a capital call. They've now been pushed aside. So you have that basket. What are some of the other baskets we've been seeing?
Yeah, I guess just to comment on that as well. I mean, I think the distress is here, right? I think there were so many headlines a year ago, even 2 years ago at this point, where you read about distress, and everybody's kind of waiting for it. And it almost feels like in the last 2 months, it's kind of quietly crept up. Where, in the last 60 days, we've gotten at least 10 opportunities to buy a deal at the debt basis.
Yeah.
Right. And for us, candidly, I don't want to say it's not our problem, but we're underwriting deals, to how they underwrite today and today's market fundamentals, today's market conditions. So we're not going to stress just to hit a debt basis necessarily. But I think it's just worth noting that it's been weekly at this point, getting deals in where a year or two ago would have been like, oh my gosh, the stress is here. But now it's like in the last 2 months, it feels like every other day there's an opportunity that has just a great story. And it's all driven by lender. It's all driven by by preferred equity, like you said. On top of that, it's like sticking to the nuts and bolts of what we do. It's the follow up. It's the long-term family owners. As much as I'm talking about distress right now, the 2 deals we have under contract aren't that profile at all. It's one deal that we've been tracking and targeting for literally 3 years, and another deal from a long-term owner that he's refinanced, he's made his money, he's willing to meet the market and exit. So I think just sticking to our process, sticking to the pipeline, offering out our number, consistently following up, staying engaged with brokers, that always bodes well for us on the acquisition side.
And I think that's a really good point, because it's not always about the story of distress necessarily. It's getting a seller that wants to transact in today's market and is willing to price the deal accordingly to allow us to underwrite no rent growth on a certain deal or a profile, or is willing to understand that interest rates aren't 3% anymore, and you can't sell a deal at a 4 cap. It just doesn't make sense. So like there is dislocation that's a result of just macro, like the uncertainties that we touched on earlier, so we don't have to rehash all that, but it's those who, Sam Zell says it best, right? Liquidity creates value.
Yeah.
When you take liquidity out, value, historically is going to come down, right? So our goal and our thesis is that liquidity has been pulled out. There's still a lot of it circling around. You hear about the billions and billions of dollars that's been raised around it. But those who can actually see through the noise and navigate the environment and have the operational expertise to do that and can transact, that sphere of buyers gets smaller and smaller depending on the profiles of the deals, right? So we see that as opportunities to be able to, again, buy based on fundamentals, not have over aggressive assumptions, but just in the nature, the nature of transacting in this world, we believe we're getting some embedded value for that in and of itself, no matter the profile of the seller. We're targeting for the most part right now 2000s and newer type product that we can underwrite, to a 5 or 7 year or a 10-year hold in some instances. Maybe there's a capital event via refinance some point in there, but we want to look at those deals on a 5 to a 7 year horizon and say, depending on the risk return profile, can we comfortably get to a, 14 to 17% IRR and a, 1.75 to 2x multiple, without outlandish assumptions, leaving room for us to be surprised for the upside, but feeling very comfortable that we've protected the downside. And can manage through the next 12, 24 months. And even if it turns into 36 months, which I don't think is going to be the case. Again, I do think we're starting to see glimpses of light, but we're also seeing, a lot of what's been boiling coming to a head here. So I think this is a situation where things could get worse in the next 2 quarters. and then start to really on the backside of 26 going into 27 start to get better. But I go back to Howard Marks, and he plays a lot in distressed credit, so it's focused around that. But the best of loans are made in the worst of times, and the worst of loans are made in the best of times. So we kind of view it as, the best of deals are made in the worst of times, and the worst of deals are made in the best of times. And I think we're seeing that story play out in terms of the worst of deals that were made in 21, 22. I mean, that's just the reality of it. Which is why we were selling. When you could be selling a 1970s vintage property, at a lower yield than you can build a brand new property to or buy a brand new property to, something's wrong in the market. And that was just really a function of free money. And a lot of those buyers have since been on the sidelines because either they can't raise any more money because they're having issues on their current portfolio, or they're just not equipped or they're not equipped to operate. And a lot of groups are struggling to raise capital, especially in the private capital space. So, that to me, again, goes back to Sam Zell thesis. And I have probably about 75 of his quotes in my phone. And, one of his other things is, buy 20 to 30% below replacement value and have staying power. It sounds very simple, but it's the staying power that not a lot of groups have. Yeah. And I think that's where we try to separate ourselves. And that's why we're very cautious about leverage. And, we look to pick our spots very conservatively. We didn't think we were going to buy another deal this year. We put Palms under contract probably or under LOI in February, closing in April.
Yep.
And really from February until September,
it was tough.
It was a futile exercise. Yeah. Every day it was just underwriting, having phone calls of nothing that was just doesn't make sense. But it's just that grind of sticking to it, and something's going to shake loose. And without fail, it typically does.
Yeah, it's like the light switch went off, right? And I don't know if year end has to play into that as well. The other thing I think to note, especially on the distress side with real estate, is things take time, right? It's not like you miss your numbers in August and the bank takes it over in September. This is 12 months, 18 months of underperformance, of not meeting certain debt covenants or certain requirements in their loan. Yeah. And it's not like a lender, you can just take it over the next day. These things take time. So the distress that you heard about 12 to 18 months ago, 24 months ago even, the deals that are being sold today are from the distress, from the last 12 to 24 months, right? So I just wanted to make that note that things move a little bit slower in real estate. So I think that's a lot of what we're seeing finally come to fruition here.
Yeah. No, I completely agree. And I think it's the extensions probably, right?
100%.
You have deals that were bought in 21 with 2-year money, and lenders gave the first year extension because they didn't want to deal with it. And they gave the second year, and now it's okay, we have no more extensions to give you.
Right.
So it's interesting. Just to circle back to the profile, we're not adverse, or we're not going to shy away from a super well-located 70s or 80s vintage property. If we can buy that deal the right way and put the necessary capital into it to kind of reset the lifespan of the major components, meaning roofs, windows, HVACs, parking lots, we will buy that deal all day long. We're very, very good at that. That's what we built our business on. But we haven't seen any deals really where you're going to get paid for that risk without taking on, some really aggressive assumptions at this point.
25 basis points in cap rate doesn't justify going from 2005 vintage to 1979 vintage, right? I mean, that's just the reality.
So we're looking at those, and it's going to be only at a really attractive basis that we look to move on something like that. But yeah, I mean, I think concessions are going to probably be super aggressive over the next 3 months. We saw it last year. It's, everybody's trying to buy occupancy moving into Q4. Q1, first 2 months of Q1 will probably be more of that same. And then we saw a really robust spring leasing season, in 2025. So we're interested to see what comes through there. But I think we positioned our portfolio well.
well occupied, right? So, and our goal is to stay well occupied through the slower winter months so that when spring leasing season does come back around, and hopefully another robust spring leasing season, we're in a position from day one to play offense. We can get more aggressive. We can test out higher market rents because we're coming from a place of 97, 98% occupied as opposed to 91, 92.
Yeah.
And I think that's a big theme for us right now. It's prioritizing occupancy, and I think we've done a great job at that. Our portfolio sits above 95% today. Yeah. We're in great markets, so I feel really good about the portfolio as a whole.
Yeah, completely agree. Couple of quick announcements here at URS Capital as looks like our families are going to be growing. Something must have been in the water here over the last 6 to 9 months. But super excited. Congratulations to Chris and Riley Gorman here, expecting their first. Just got married, wasting no time, but been together for a long time. So congratulations. Hope Riley's doing well.
Married and pregnant in Q3. So right. We're efficient.
Excellent. Finishing the year strong. Also want to recognize Michaela Brown, who's been with us now just about a year as well, is also expecting. She's been a big part of helping us get some of the infrastructure and the operations and on the corporate side initiatives for URS Properties and URS Capital Partners. So big congratulations to her and her husband, Thomas. I want to take a second and introduce Jennifer O'Brien, our new COO of URS Properties. She came to us in September of this year, so she's been with us about a month and a half. Feels like she's been here for 6 months already. She's already having a massive impact, but she's really, we're super excited to have Jen on the team. She comes with a tremendous background, 7 years at an extremely large Southeast-based third-party property management company. And more importantly, I think for me, what stood out was that she was with them from literally 7 properties to 86 properties. So saw the portfolio go from, 1,500 units to over 15,000 units and was a critical part of that growth as their COO through that process. So very fortunate to have her on the team. She's already making a big impact and is going to be a fantastic addition for the long term as we look to continue to grow and scale.
We've reached the end of our presentation. This is really excited. I'm happy to be a part of this. I look forward to continuing to do these quarterly, just being more transparent, being more out in the open to our investors, to our partners, brokers, really anybody. So we do have a new website. It's urscapitalpartners.com. Please do check it out. Really excited about that. You'll be seeing more of us here on LinkedIn and on our email distribution list to our investors, and look forward to checking back in Q4.
All right. Well, great job, Chris. Really appreciate you joining me. These are not that easy. We know they're long, so we appreciate all of you that took the time. We hope you enjoyed it. It's great for us. Hope you get the understanding of like the level of detail and attention if you're an existing investor that we put into the portfolio on your behalf. Obviously, you're our lifeline here, and we respect your investments with URS Capital tremendously. And those of you that are watching, considering speaking to us about, future investments, please feel free to reach out to Rebecca at urscapitalpartners.com. But as you can see here, our mission is pretty straight, and cuts right to it. It's to generate superior returns for our partners while curating communities that our residents are proud to call home. That's really the underlying theme of URS Capital Partners and URS Properties. It's our residents and our investors and our team members, most importantly. So thanks for taking the time. Look forward to the next update here at the end of Q4.
Thanks, everybody.